It is the last day of school here in Pratt, Kansas, and I think it's good just to take a minute and be grateful that we live in the Midwest. Our kids are finishing a school year where they didn't take a single day off because of COVID related issues. They were able to participate in everything, and I think it's just a huge win for these communities that we were able to function. So it's good to offer gratitude where you can, and I really think we're blessed to be in the Midwest and around people that have level heads on their shoulders. So to everybody that plays a part in that, we're always grateful for that. All right, let's turn to markets. But before we get too heavy into markets, I kind of want to go through some basics and some nuts and bolts of how we think about things and how we think about life in general as risk managers. Okay, so if you've ever been in my office and you've ever been in front of a whiteboard, well, there's a 100% chance that I've gotten up and drawn some risk graphs for you. And so the reason we do that is because it's not necessarily about being right or wrong in any given market. What we're trying to do with the farm is we're trying to underline and create a risk graph that works for you. And so when the markets get volatile, these risk graphs really do function and really do work. So what you've got in front of you right here is really, really simple. And I hope everybody can see it. I'll make it a little bit bigger so that it comes through. On this graph, right, we have a break-even line. So now this isn't necessarily corn or wheat or beans. It's any trade you would ever put on any security, okay? Anytime you put something on, you are operating around a break-even. Before you put the trade on, you have all your money. After you put the trade on, the amount of money you have either grows or it declines. And that's whether you're right or you're wrong. And so what you're looking at here is what your farm's risk graph looks like every day of your life. And this is really simple. I know everyone's going to be like, oh, well, duh. Why are you showing us this? Well, because most people don't really realize it. When you are long agriculture or long land, you are multi-year long corn futures or soybean futures. And so your graph always looks like this. You gain penny for penny as the price of your commodity goes up, and you lose penny for penny as the price of your commodity goes down. And so, in its most basic sense, what our role is and our goal is to shift this line as far over as we can and then shift it to where you have no downside risk, right? That is the essential function of everybody in this industry. But it's an elusive target because if you started playing this game when corn was at $4 and $4.20 and $4.30, then what we've actually done, if we had played that game, right, and you scale into sales because the price of corn went up, what we would have actually done in this instance is we would have actually shifted your graph to the left. Yes, we would have left yourself here with no downside risk, but we would have limited your upside risk. And so instead of having a direct vertical line, your slope of your gain would have been lower because you're constantly having to throw money to increase your floor as the market goes up. And so I don't like that at all. I don't like to lower the slope of these graphs. I like to increase them like this, right? Which is why we're always looking for opportunities and looking for technicals to put ourselves in a situation where we can actually do this with our graphs in our trades. We actually want to move them up. We want to take these things up and out of here like this. And we want to increase the slope. So that's why we want to be aggressive, because we know we're multi-year long, and so we got to make the most we can now without taking an excessive amount of risk. So why are we going through all that? Well, because when you look at corn here recently, okay, hold on, let me get my corn chart up. There we go. All right, so when we look at new crop corn, all right, where would you have started hedging, and what would it have cost you to hedge? If you were really good, you started hedging probably around this $4 mark. I know we fought everybody about hedging $4 corn, and you would have spent about 50 cents. So there your floor, right? If we draw that graph at $4, your floor is actually $3.50 if you spend 50 cents on a put. And now as you've gone up, your floor, had we done that, is actually, if we lose 50 cents here and you keep throwing money at it, you would have lost $1 or $1.25 in actual cash dollars in order to hedge $4 corn. So now here we are sitting at $5.15 and we don't have anything to show for it. And so I think the traditional approach has not worked in this market, which is why we've been very, very hands off, because your risk in this environment is over trading it and getting yourself into a position where you're just feeding the monster with your cash. And so that's something we don't want to do. So we took a stab right here because we had a great sell signal, right? We have this big, nice move to the upside. We've got a chart reversal right here. We've got a secondary rally followed by a reversal. That's a really good sell signal. And so that was the first hedge attempt that we had taken this year. But then the market just turned around and immediately said, nope, you are incorrect, you are wrong. And so when the market does that, you got to listen to it, and you got to kind of dig and understand what it's telling you. And when you study these charts and you study these movements, what this move right here is telling us, especially when you overlay different indicators, right? We look at lots of them, and I don't necessarily want to get into all of them here. But when you overlay all these indicators, they draw a conclusion for you, and they tell you what you need to be thinking, basically, right? And what this is telling us, and I believe this with 100% conviction to my very core, that this is a buy, and these new highs are going to go away. And I think we've got some targets here that are really good. And I'm going to show you this on the balance sheet here in a second. I know the fear is palpable, and everyone's going to say, "Oh no, it doesn't work that way." We are at the top of our daily cloud. We're on a deep pullback, or we're in a pullback from a very large rally. On the weekly chart, that's all we've done is pull back. When this thing reignites, our target is $8 December corn. Can we get there? Absolutely. And let's go into why, right? Let's go back to basics. This is what the May WASDE says. And you guys all know that this number is the only number in our business that counts, is the ending balance sheet of any given year. This year is not like other years, because in every other year that I've done this business, you're always talking about what if scenarios of what if we don't yield, or what if we what if these things happen, maybe we'll get a bull run. Well, this year is so different for so many reasons, and I know we're down, and I know the weather's perfect, and I know all this stuff is happening, and it feels gross, but this is the truth. This has not shifted anything at all. This is what the USDA says we're going to do. And remember, to get to this number, the USDA made two crucial assumptions in its numbers. It cut demand by 375 million bushels on exports, and it left the safrinha crop where it was at 103 million metric tons. They've made two crucial decisions there, and they're incorrect on both. Why do we think that? Well, because every analyst report that you read about South America has that South American crop below 95. Very, very few have it above it. And everybody that's on the ground down there says, no, it's not that high. When you look at our demand numbers, they are off the charts. We've got cattle margins screaming higher. You've got livestock numbers that are high. Our feed demand is increasing, not decreasing. Ethanol margins are almost $2 per bushel positive. So for every bushel that an ethanol plant buys at $8 corn, it's making $2 a bushel in free cash flow to its operations. They're going to grind this stuff like crazy because the energy complex is exploding. So you've got extremely high ethanol margins, you've got extremely bad high feed numbers, and you've got China that is buying like crazy and suggesting that the USDA is wrong on their number. So the next thing that we start to talk about is whether or not we end up with a yield of 179.5. And how many acres are we going to have, right? There's all kinds of assumptions going on. I had a really good friend tell me last night, we're going to plant 100 million acres of corn because we're above $5. I don't think so, because you got too many other things going on, right? You've got high wheat prices, you've got drought in a lot of places, you've got oil seeds that are going off the charts. So a lot of those fringe acres that people think are going to go to corn probably aren't, because they just can't get there. So what does our balance sheet do? What does the truth actually tell us? And where does our risk lie? And here's what it is. If we increase 6 million acres, and if we increase 3 million acres, okay, there's two numbers here. We're going to increase above 91.1. Let's just assume that. But let's make two assumptions, okay? Number one, let's assume that the USDA increases or is 400 million bushels off. Now that can be from in total, 400 million off on ethanol, 400 million off on feed, exports, maybe last year's crop ending carryout was overstated. However you get there, however you want to slice it, let's just say that number needs to move 400 million. Well, if I put that back in, and you'll see these numbers change, we start to get pretty tight, right? So our carryout, if that happens, doesn't necessarily increase by very much. Now, what if the safrinha crop is too low or too highly estimated? What if it comes in under? What if China does continue to take? What if ethanol does return to 100% of pre-COVID? What if all these things happen? These are what if scenarios that we have not had the opportunity to fiddle with, where the USDA has made all of the bearish assumptions and none of the bullish ones. Guys, this number could move as high as 750 million bushels if the safrinha crop turns off. And so we've talked for weeks and weeks and weeks about the importance of yield this year, because 179.5 is the highest yield we've ever had in the United States by over 3 bushels per acre. What if we're off a mere 3% from that, and we have a yield 2 bushel better than last year, which would take almost perfect weather to get to? What if we equal last year's yield? What if we just equal it? Watch these numbers drop. There's 522. This is a sub-billion with a 6 million acre increase. That's a sub-billion bushel carryout, 6.4%. What if something crazy happens and we drop this thing 7.5%? These are risks that the market can't afford. And so what's the next most likely move? What is the market doing if it collapses from here and puts us down to 450, puts us down to 475? How long will we stay down there? Well, in those instances, what happens to the ethanol margin? Well, it screams higher, right? It goes from $2 a bushel to something more. What does China do if they're short corn and need to feed their people if we continue to collapse our grain prices? Do they cancel, or do they buy more? What do the feeders do, and all of the end users? What do they do on a break? Did they just sit on their laurels and do nothing like they did the entire move up? No. Bull markets are tough. They let you in. That's what this is telling you. Bull markets break. As one really good analyst would say, bulls are hard to ride because they buck and they kick and they snort, right? So what does it look like on a weekly chart? Well, we've got a big, hairy, nasty break. But look at the break in context of the move. It's irrelevant. It doesn't matter. We're still charging higher on these grain markets, and we're setting ourselves up for a new and sustained rally. And guys, this is just corn. Beans are even more bullish than corn potentially because their carry out, the USDA has just said, hey, it's 140 and we don't know what to do about it, right? But I think they did that on purpose because they knew that there's an issue with corn, and that issue is not going away and has not solved itself. Another thing that I think is interesting here is what wheat did yesterday. So as corn collapsed, wheat gained 27 cents on corn yesterday on the nearby contracts. So we've been talking about wheat for a long time, and I'm extremely bullish all the wheat classes from here. And I was bullish at 7. I think wheat is really undervalued. But why is it where it is? Well, it's down here because it's trying to extend corn. You've got sourcing issues running rampant through western Kansas and where they're feeding the cattle, right? They can't find they can't find the feedstock. So they're switching their rations all the time. They're switching to barley, they're switching to corn, they're switching to wheat. They're changing it with every new pen that they start. And that's because they can't find it. And so what wheat has done is kind of put itself on the table and said, we'll devalue ourselves in order to extend corn. And so eventually the USDA feed number is going to increase on wheat, and that carryout's going to come down even with a huge crop. We better grow all the bushels in wheat that the Kansas Wheat Tour said we're going to grow. We better have it, or else we're going to be in a real shortage of wheat too. So where does this spread trade back to? Well, normal is up into this range, up to $1 to $1.50 premium to corn. We gained 27 cents on this spread yesterday, and I would expect it to test it just a little bit and then just continue working higher. And I think that it's got to outpace corn. So if corn rallies from here, or in the very, very near future, corn rallies, I think wheat outpaces it on the gain by to the tune of $1 or $2 a bushel, because it's not going to be in a position where it can overfeed itself anymore. So recent price action aside, which is, I get it, nobody likes yesterday, nobody likes this big sell-off. Recent price action aside, you got to step back and look at what the market's really telling us. And the risk in this thing is to the upside, not the downside. We read everything we can get our mitts on. Bearish people, bullish people. We read all kinds of things. And when the market breaks, people tend to have to rationalize it with, well, it broke for a reason. Well, it went up for a reason. And markets ebb and they flow without reasons sometimes. Maybe the reason we sold off yesterday is because China has now put two investment or agricultural research groups in prison, shut down their operations and forbid them from telling the truth. So they put them in jail. And on Monday, they also outlawed and made it illegal to speculate on commodities. So if you're a hedge fund manager in China and you came to work on Monday feeling really good about yourself, and then on Tuesday, and they have different levels of laws. They have, we have felonies and misdemeanors and stuff. over there they have different levels, and the one that they put on the commodity ban is equivalent to treason. So you came to work on Tuesday thinking all was good, to find out that you're actually a traitor in China if you have a speculative position on in any commodity. And so what do you have to do? Well, you have to liquidate. And those funds have positions in the US corn market. So what happened? Boom, they crash. And so are they crashing it just to manipulate our price? Maybe. They've dumped 1 billion bushels of wheat, 1 billion bushels of rice. They've dumped all their corn. They bought all of South America. They bought all of the US. They bought all of the Ukraine. They've bought everybody's materials, and now they're continuing to try to keep these commodity prices under check. So with those things happening, don't fall for the thought that we're just going to come back to $3 corn because we're going to have a 2 billion bushel carry out and, oh, we missed it. I don't believe that for 1 second, because I don't see anything out there that tells us that that's true. Now, the weather is good. The weather looks good. But there are a lot of forecasters out there that are suggesting that you got to get through the wet to get to the dry. And I'm not a weatherman. I know very little about weather, but I'm listening very carefully to what they're saying. And we are not out of the woods. We have way too many issues underlying in Michigan, Minnesota, northern Iowa. You've got issues in the Dakotas, all of which have very low moisture profiles, and they continue to miss the rains that we're getting. So it's raining in places, but it's not raining where it's dry. And so to think that our yield is going to be, are the conditions are ripe for a record yield on all these fringe acres that we're going to plant, I think it's way too early to make that assumption. And you add all that up, and this break is a buying opportunity. So, and I know I'm over my time, so I'm going to wrap it up. What we're going to be doing in the next 2 days is lifting hedges. We're coming out of them, and we're going to reopen that upside up, and we're going to be taking long positions, because everything about this break reeks of fear, reeks of manipulation, and reeks of just a bull that's kicking. And so I think you got to be really cognizant of that and be prepared to take the next move to the upside. So with that, I hope you guys have a great week. There is always risk trading futures and options. So when you do it, manage your positions. Do it in a way that you can afford to ride the waves and ride the machine, and always trade carefully. So I hope you guys have a great week. We will talk to you again next week. I will be out on vacation. I'll have Jeff and Phil here give a quick overview of what's going on, and obviously if something changes, we will flip too. But as of today, we just don't see that as necessary. So I will talk to you next week. Hope you have a good one.